Picture this. It's the year 1600. No smartphones, no internet, no Amazon Prime delivering spices to your door in 2 days. If you want a pepper, yes, pepper, you might have to wait months, maybe years. And you'd pay a fortune for it. This is the world before the stock market, before corporations as we know them, before you could own a tiny slice of a company by tapping a button on your phone. But it's also the world that made all of that possible. What happened in Amsterdam in 1602 didn't just change how people invested money. It changed how the entire world works. At the turn of the 17th century, the world was a much bigger place. Traveling from Europe to Asia could take 6 months to a year if you survived at all. There were no maps you could trust, no weather forecasts, no GPS. You set sail into the unknown, and you hoped. And yet, people were obsessed with connecting the world. The driving force was simple. People wanted stuff they couldn't get at home. They wanted it badly, and they were willing to risk their lives and fortunes to get it. At the center of this obsession were spices. Spices weren't just about flavor. They were about survival, status, and power. In an age before refrigeration, spices helped preserve meat. They masked the taste of food going bad. They were used in medicine. And crucially, they were rare. Black pepper, nutmeg, cloves, cinnamon, these came from distant lands in Southeast Asia, and getting them from there to Europe was nearly impossible. A single sack of cloves could be worth more than a year's wages. A shipload of nutmeg could make you richer than a king. But the journey to get those spices was a nightmare. Let's say you're a European merchant in the 1500s who wants to bring spices back from Asia. First, you need a ship, expensive as building a small castle. Then you need a crew willing to risk their lives for wages that might never come if the ship doesn't return. Disease was rampant. Scurvy, dysentery, typhus. Storms could destroy your ship in minutes. And if the weather didn't kill you, pirates would. The seas between Europe and Asia were infested with them. English pirates preyed on Spanish ships. Dutch pirates attacked Portuguese vessels. If you were carrying valuable cargo, you were a target. But let's say you survive the pirates and make it to the Spice Islands in what is now Indonesia. Now you have to negotiate with local traders who know exactly how desperate you are. Then you load your ship and make the same deadly journey back. 6 months to a year at sea. Same storms. Same pirates. Same diseases. Many ships never made a home. Some were lost in storms. Some were captured. Some simply vanished. And even if your ship did make it back, there was no guarantee of profit. Maybe the market was flooded. Maybe your spices got ruined. The risks were infinite. But if everything went right, you could become unimaginably wealthy. That tiny possibility drove men to madness, drove nations to war, and drove the entire world economy. By the late 1500s, control of the spice trade had become geopolitical chess. Portugal dominated. In 1498, Vasco da Gama rounded the southern tip of Africa and reached India, one of history's most important voyages. Suddenly, Portugal had a direct sea route to spices, cutting out Ottoman and Arab middlemen. For most of the 16th century, Portugal controlled the spice trade through military force and fortresses across Asia and Africa. If you wanted spices, you bought them from the Portuguese, or you didn't get them at all. But monopolies never last forever. Spain wanted more. England was eager to build its empire. And then there was a small, rebellious region in Northern Europe that no one expected to become a major player, the Dutch Republic. The Netherlands should not have become a global superpower. It's small, low-lying, much of it below sea level. The land is marshy and difficult to farm. There are no mountains, no natural defenses. But the Dutch had something going for them. They were stubborn, resourceful, and obsessed with trade. For centuries, they'd been building dikes, draining swamps, and reclaiming land from the sea. They became experts at water management and shipbuilding. They learned to turn geographical disadvantages into advantages. No farmland, build ships and become traders. No natural resources, import raw materials, turn them into finished goods, and sell them for profit. By the late 1500s, Amsterdam had grown into one of Europe's busiest ports. Dutch shipbuilders developed the Flight, a cargo ship cheaper to build, easier to sail, and more efficient than anything else on the water. They could transport goods faster and cheaper than anyone, which meant they dominated trade routes. Amsterdam became Europe's logistics hub. Warehouses stacked with goods, docks crowded with ships, streets filled with traders speaking a dozen languages. It was loud, chaotic, filthy, and utterly alive. And the Dutch were getting very, very rich. But wealth alone doesn't make a superpower. The Dutch had something else. They were angry. For much of the 16th century, the Netherlands was part of the Spanish Empire. Spain was the most powerful nation on earth, fervently Catholic and determined to stamp out Protestantism. Many Dutch had converted to Protestantism. They didn't want to be ruled by a Catholic king in faraway Spain. Tensions boiled over, and in 1568, the Dutch revolt began. This wasn't some minor skirmish. It was an 80-year war. The Spanish army tried to crush the rebellion, but the Dutch controlled the waterways, flooded fields to slow Spanish advances, and used their wealth to hire mercenaries. By 1600, the Dutch were winning. The Dutch Republic had effectively become an independent nation. And with independence came opportunity. Once free from Spanish control, the Dutch looked at the world's trade routes and saw opportunity. At the top of their list, the spice trade. Portugal, their old enemy and Spain's ally, still controlled much of Asian trade. But Portugal was weakening. In 1580, Spain had absorbed Portugal, stretching Portuguese resources thin. The Dutch saw an opening. In the 1590s, Dutch merchants began sending expeditions to Asia. The first Dutch fleet reached the East Indies in 1595, led by Cornelis de Houtman. It was not glamorous. Houtman was a terrible leader. His crew suffered from disease and hunger, and more than half died. But they came back with spices, and that was enough. News spread like wildfire. Suddenly, every merchant in Amsterdam wanted in. New companies formed overnight, each raising money to fund expeditions to the East Indies. Between 1598 and 1601, dozens of Dutch ships set sail for Asia, each representing a separate venture, a separate gamble. It was chaotic, competitive, and incredibly risky. Here's how it worked before 1602. You were a wealthy merchant who wanted to profit from spices. You couldn't just buy them at market. Someone had to get them first. So you'd join with other merchants, pool your money, and fund an expedition. You'd buy a ship, hire a crew, stock it with trade goods, and send it to Asia. This was called a voorcompagnie, a pre-company. It wasn't permanent. It was organized for one voyage. If the ship came back successfully, you'd sell the cargo, split profits, and dissolve the company. Then you'd start over. This model had one massive flaw. Risk was not spread out. If the ship sank, you lost everything. Every guilder invested was gone. No insurance, no safety net. Ships sank all the time. Storms, pirates, crew mutinies, navigation errors, disease. For wealthy merchants, losing one ship was painful but survivable. But for smaller investors who had scraped together everything for a single voyage, one failure meant financial ruin. Yet people kept investing. Why? Because a successful voyage could return 400% profits, sometimes more. That potential kept people gambling, but it also created instability. Because every voyage was a separate company, there was no coordination. Dutch ships would arrive in Asia and compete against other Dutch ships, driving down prices. It was chaos. Meanwhile, competitors were watching. The English had formed the English East India Company in 1600, a joint stock company that coordinated English trade, owned multiple ships, and spread risk across all of them. The Dutch were getting left behind. By 1602, something had to change. The old model was too risky, too chaotic, too inefficient. They needed a way to pool resources, spread risk, and coordinate efforts. They needed a permanent institution that could survive individual losses. They needed something that had never existed before. By early 1602, the situation was absurd. Too many Dutch companies, too many ships, too much competition. All Dutch merchants competing against each other. Between 1598 and 1601, at least 14 different Dutch companies sent ships to Asia, each operating independently, each undercutting the others. A Dutch ship would arrive at a port, negotiate a price for nutmeg. Then another Dutch ship would show up and local traders would raise prices. Both captains overpaid. When they returned to Amsterdam, they'd find a market flooded with spices. Prices crashed. Everyone made less money. The English East India Company was operating as a unified entity, coordinating voyages and negotiating as one voice. They got better prices and deals. But the Dutch? Chaos. The Dutch government, the States General, decided to intervene. Their proposal: stop competing with each other. Merge all these separate companies into one giant company. Pool all resources into a single entity. And in exchange, they'd give them something valuable: a monopoly. A 21-year monopoly on all Dutch trade east of the Cape of Good Hope. If you want to trade with Asia as a Dutch merchant, you had to go through this new company. No exceptions. This was a sweetheart deal, but it came with strings. First, the company would act as an extension of the Dutch state. It would have power to sign treaties, build forts, maintain armies, and wage war. It would be a company, but also a quasi-government and military force. Second, the company would raise money from the public, not just from wealthy merchants, but from anyone who wanted to invest. The company would sell shares, pieces of ownership, and anyone could buy them. This was revolutionary. On March 20th, 1602, the Dutch government granted the charter. The Verenigde Oostindische Company was born. The VOC. The company. The VOC wasn't the first joint stock company, but it supercharged the concept. It was permanent. Most companies were still temporary, tied to individual voyages. The VOC was designed to last 21 years, and shares represented ownership in the entire enterprise forever. Shares could be traded. When you bought VOC shares, you could sell them to someone else anytime you wanted. This created something that had never existed: a secondary market where people traded pieces of companies. The company had sovereign powers. The VOC could build forts, maintain armies, sign treaties, and declare war. It could establish colonies and govern territories. In the East Indies, the VOC was the Dutch Republic. This combination made the VOC the most powerful corporation the world had ever seen. At its peak, it would be worth more than Apple, Google, and Microsoft combined, adjusted for inflation. But in 1602, it was just getting started. First, it needed to raise money. In summer 1602, the VOC began selling shares to the public, the first initial public offering in history. The first time an ordinary person could buy a piece of company and become a part owner. The offering was open to anyone in the Dutch Republic. Rich merchants, sure, but also shopkeepers, widows, artisans, even servants with savings. The minimum investment was low enough for regular people to participate. When you bought shares, your name was recorded in a ledger kept by the local VOC chamber. If you wanted to sell, you'd find a buyer, agree on a price, go to the chamber together, and have the transaction recorded. This might not sound like a big deal, but it was everything. Shares had liquidity. You could turn them into cash whenever you wanted. You weren't locked in. The response was overwhelming. By year's end, the company had raised about 6.5 million guilders, a staggering sum equivalent to hundreds of millions or possibly over $1 billion today. More money than had ever been raised for a single venture in history. Amsterdam alone contributed 3.7 million guilders. The city's wealthiest merchants bought in, but so did thousands of ordinary citizens. Bakers, tailors, brewers, carpenters, people who had never invested before suddenly owned pieces of the most ambitious company ever created. Why? Patriotism. The VOC was a symbol of Dutch independence. Greed. They'd heard stories of enormous profits. FOMO. Everyone was investing. And trust. The VOC had government backing and a monopoly. Women were among early investors, unusual for the time. The Dutch Republic gave women more economic rights than most of Europe. They could own property, run businesses, and invest. For the first time in history, ordinary people could own a piece of a major enterprise. They weren't just workers or customers. They were owners, shareholders, capitalists. Once people owned shares that wanted to trade them, maybe you needed cash for an emergency. Maybe you'd lost confidence. Maybe you want to take profits. Supply and demand created market. At first, trades happened informally, meeting at a tavern, agreeing on price, going to the VOC chamber to record it. But as volume increased, People needed a more efficient system, a place where buyers and sellers could gather, where prices could be negotiated publicly. The Amsterdam Bourse already existed, a building where merchants traded commodities, grain, timber, cloth, herrings. Now, people started trading VOC shares there too. This was the birth of the stock market as we know it. Not a place for goods, but for ownership in companies, where share prices could change hour by hour based on supply, demand, rumor, and emotion. The Amsterdam Stock Exchange, the world's first, had arrived. You'd arrive at the Bourse, look for brokers who connected buyers and sellers, tell them you wanted to sell shares, and name your price. The broker would circulate, shouting offers. Eventually someone would be interested. You'd negotiate, agree on price, then go to the VOC chamber to record the transaction officially. Simple, right? Except people started getting creative. Share prices started fluctuating based on news. Good news from Asia? Prices rise. A ship returned with spices? Prices up. Rumors of war? Prices down. A storm destroyed part of the fleet? Prices crashed. For the first time ever, people could watch their investment value change daily. That created something new: speculation. Speculators didn't care about owning shares long-term or dividends. They just wanted to buy low and sell high. They'd watch for rumors, bet on price movements, try to time the market. Some made fortunes. Others lost everything. Sound familiar? What happened in Amsterdam in 1602 is exactly what happens on Wall Street today. The technology has changed. Human psychology hasn't. Isaac Lumiere was one of the largest initial investors. He put in 85,000 guilders and sat on the board. Then he got greedy. Lumiere started engaging in trades that benefited him personally at others' expense. He used insider information to buy and sell at advantageous times. He manipulated prices. Eventually, the VOC kicked him out in 1605. But Lumiere didn't give up. He became the world's first short seller. He'd borrow shares, sell them at current price, wait for price to drop, buy them back cheaper, return them, and pocket the difference. Lumiere started shorting VOC shares, spreading negative rumors, ships sinking, conflicts, financial troubles. He'd profit from the panic. It worked for a while. But the VOC lobbied the government, and in 1610, the Dutch government banned short selling, possibly the first financial regulation in history. As the market grew, so did fraud. Information was power. If you knew something before everyone else, say, a ship returned with valuable cargo, you could buy shares before news became public and sell after prices spiked. This is insider trading. It was rampant in 1600s Amsterdam. VOC employees leaked information to friends. Ship captains sent advance messages. Brokers spread false rumors to manipulate prices. There was no SEC, no rules, no penalties. It was the financial Wild West. Some schemes were elaborate, secret alliances to drive prices up or down, coordinated rumors, manipulation of ledger recording. Thrilling, profitable chaos for those who knew how to play. Devastating for ordinary investors who didn't. In the first years after the IPO, share prices rose as optimism grew. People were making money on paper. But in 1607, reality hit. The VOC's first major fleet returned from Asia after years away. Investors expected massive profits. What they got was disappointing. The voyage had been expensive. Many ships were lost. The cargo was valuable, but not as valuable as hoped. The first dividend was modest, much smaller than the hype suggested. Share prices dropped. People who'd bought at inflated prices realized they'd overpaid. Panic selling began. Prices fell further. This wasn't a full crash. The VOC would recover, but it was a wake-up call. The market's first lesson in the difference between expectation and reality. As fraud became common, pressure grew for government intervention. Merchants who'd been cheated demanded accountability. The VOC wanted to prevent people from undermining confidence. The Dutch government began regulating the market. In 1610, they banned short selling. In following years, they introduced requirements for recording transactions more transparently, penalties for spreading false rumors, restrictions on speculative trades. These regulations were primitive and inconsistently enforced, but they represented the first attempts to bring order to chaos to create rules for how markets should operate. The beginning of financial regulation, a process that continues today. For shareholders in Amsterdam, the early decades were incredibly lucrative. The first dividend in 1610 was modest, about 7.5%. But by the 1620s and 1630s, dividends averaged 15 to 20% per year. Some years hit 40 or 50%. VOC shares became one of Europe's safest and most profitable investments. Widows bought them for steady income. Orphanages invested in endowments. Churches held shares. The wealth wasn't just financial. The VOC brought back porcelain from China, silk from Japan, tea, coffee, exotic woods, precious stones. Amsterdam's golden age, its explosion of art, architecture, science, and culture in the 1600s, was funded largely by VOC profits. Rembrandt, Vermeer, the canals, the grand houses, all built on the back of a company that started by selling shares to ordinary citizens. But there was a dark side. The VOC success came at horrific cost, paid by millions who never owned a share. In Asia, the VOC used violence and coercion to establish its monopoly. When local rulers refused to trade exclusively with the Dutch, the VOC destroyed ports, burned ships, and blockaded coastlines. The VOC enslaved people. It forced Indonesian farmers to grow only spices, creating artificial scarcity to drive up European prices. If farmers tried to sell to others or destroyed spice plants to resist, the VOC punished entire villages. Mass executions, deliberate famines, systematic brutality. In 1621, VOC Governor-General Jan Pieterszoon Cohen ordered the near-complete extermination of the Banda Islands population. Thousands killed or enslaved to secure a nutmeg monopoly. He wrote to Amsterdam justifying the massacre as necessary for business. The directors in Amsterdam approved because it was profitable. This is the uncomfortable truth about the stock market's birth. It wasn't just clever financial innovation. It was also a mechanism allowing ordinary people, shopkeepers, bakers, widows, to profit from violence and exploitation happening on the other side of the world without feeling directly responsible. The distance between investor and action created moral disconnect. If you owned VOC shares in Amsterdam, you probably didn't think much about how profits were generated. You just saw dividends appearing, clean money, paper profits, abstract wealth. But there was nothing abstract about what was happening in Asia. This pattern, where financial systems allow people to profit from harm without feeling responsible, is still with us. It's one of the most troubling legacies of the system born in 1602. By late 1600s, the VOC showed trouble. The first problem was bureaucracy. It had grown too big, too fast. Communication was slow. Decision-making was sluggish. The second problem was corruption. VOC employees in Asia, far from oversight, skimmed profits. They'd engage in private trade, accept bribes, falsify records. Some became fabulously wealthy while the company saw diminishing returns. The third problem was competition. The monopoly was breaking down. The English East India Company was growing stronger. Other European powers established trading companies. The VOC's dominance was challenged. The fourth problem was costs. Maintaining an empire is expensive. Armies, forts, administrators, ships, wars. Costs grew, eating into profits. Finally, there was complacency. The VOC had been successful so long it stopped innovating. It relied on old strategies while the world changed. Throughout the 1700s, profits shrank. Dividends became irregular. Share prices fluctuated wildly. Sometimes the company paid dividends not from profits, but by borrowing money or selling assets, a sign of desperation. By mid-1700s, the VOC was effectively bankrupt. It owed massive debts. Its infrastructure crumbled. Its ships were outdated. But it kept staggering on, propped up by the Dutch government. Finally, in 1799, the VOC was officially dissolved. After nearly 200 years, the company once worth trillions was gone. Its assets were taken over by the Dutch government. Its territories became formal colonies. Its debts were absorbed by the state. Shareholders were left with nothing. The VOC's collapse taught lessons that have been repeated many times since, but rarely learned. Even as the VOC declined, the system it pioneered spread across the world. Other countries looked at Dutch wealth and wanted to replicate it. England's East India Company adopted permanent joint stock ownership and public trading, eventually becoming even more powerful than the VOC. France followed with the French East India Company. Sweden, Denmark, Austria, nearly every European nation with maritime ambitions created its own version. The stock market itself spread. London established its own exchange, formally in 1801 with the London Stock Exchange. In 1792, 24 stockbrokers met under a buttonwood tree on Wall Street in New York. They signed the Buttonwood Agreement, the founding document of what would become the New York Stock Exchange. At the time, the United States was barely a decade old. The economy was small and fragile. But American finance founders understood that if they wanted the country to grow, they needed a way to pool capital, spread risk, and allow ordinary people to invest in ventures. They needed what Amsterdam created in 1602. The New York Stock Exchange started small. For decades, it was a backwater compared to London or Amsterdam. But as the American economy grew, through industrialization, railroads, oil, steel, the stock market grew with it. By the early 1900s, New York became the world's financial capital. The New York Stock Exchange became the largest and most important in history. But the basic principles remained the same ones the VOC pioneered. Joint stock ownership, tradable shares, public markets, secondary trading, speculation. Amsterdam invented it. New York perfected it. The technology of stock trading has changed almost beyond recognition since 1602. In Amsterdam, trades were recorded by hand in ledgers. You had to physically go to the VOC chamber. If you wanted current prices, you had to ask around at the exchange. The 1800s brought telegraphs, allowing stock prices to transmit across distances instantly. Then telephones, then computers, then the internet. Today, most trading is done by algorithms, programs that buy and sell thousands of times per second, faster than any human could react. High-frequency trading firms exploit tiny price differences that exist for fractions of a second. They use machine learning to predict market movements. They trade based on satellite data, weather patterns, social media sentiment. The technology is wildly different, but the underlying concept, it's still the same. People buy and sell pieces of companies, hoping prices will go up. The tools have changed. Human nature hasn't. Today, stock markets exist in virtually every country. Tokyo, Hong Kong, Shanghai, Mumbai, London, Frankfurt, Sao Paulo. Hundreds of exchanges trading trillions daily. You can buy shares in a Japanese car company from your phone in Nigeria. You can invest in a Brazilian mining firm from your laptop in Sweden. The market is global, interconnected, 24/7. And it all traces back to Amsterdam, 1602. Here's a strange fact. The human brain hasn't evolved to handle stock markets. For most of history, our ancestors made decisions based on immediate, tangible information. Is this berry poisonous? Is that animal dangerous? We evolved to handle concrete, physical risks. But stock markets are abstract. Numbers on screens. Fluctuating prices representing future expectations of corporate earnings. Our ancient brains struggle to make sense of it. The result? We make predictable mistakes. Every market boom and bust comes down to two emotions, fear and greed. When markets rise, greed takes over. We see others making money and want in. We convince ourselves this time is different, that prices will keep rising forever. We ignore warning signs. We buy at the top, right before the crash. This happened in Amsterdam during 1630s tulip mania, when tulip bulb prices rose to absurd levels driven by speculation before collapsing catastrophically. People knew it was insane, but couldn't help themselves. Then the crash comes, and fear takes over. Prices fall. Panic spreads. Everyone tries to sell at once. We convince ourselves the market will never recover. We sell at the bottom, locking in losses. This pattern has repeated throughout history. The South Sea Bubble of 1720. The railroad mania of the 1840s, the Roaring '20s and 1929 crash. the dot-com bubble of the late 1990s, the 2008 housing bubble and financial crisis, cryptocurrency boom and bust cycles, different assets, different technologies, same psychology. But here's the twist. Even though our brains aren't built for markets, markets were built for our brains. Stock markets exploit every cognitive bias, every emotional trigger, every psychological weakness humans have. Loss aversion. We feel loss pain more intensely than gain pleasure. Markets exploit this. Fear of loss drives irrational decisions. Herd mentality. We look to others for cues. When everyone buys, we buy. When everyone sells, we sell. Bubbles form because everyone follows the herd. Recency bias. We overweight recent events and assume they'll continue. Markets exploit this. We buy high and sell low. Overconfidence. We think we're smarter than we are. We think we can time markets and pick winners. Markets exploit this. Most active traders underperform because they trade too much. The stock market is, in a sense, a machine designed to separate people from money by exploiting psychological vulnerabilities. It's not malicious. It's just how the system works. When you feel excitement watching your portfolio rise, that's the same feeling Dutch merchants felt watching VOC prices rise. When you feel anxiety seeing red numbers, that's the same fear that gripped Amsterdam investors when rumors spread of ships lost at sea. When you hear about a hot stock and feel urged to buy before missing out, that's the same FOMO that drove people to invest in the VOC in 1602. The technology has changed. The speed has increased. But the emotions, the psychology, the human experience of investing, that hasn't changed at all. The global financial system, stock markets, corporations, trillions traded daily, all traces back to a single moment in Amsterdam in 1602. A group of Dutch merchants, frustrated by competition and risk, decided to try something new. They formed a company. They sold shares to the public. They allowed those shares to be traded. In doing so, they created something that would reshape the world. Today, that system is everywhere. It's in your retirement account, your pension fund. It's in the apps on your phone. It's in the companies that build your cars, grow your food, provide your electricity. It's woven in a modern life so deeply we don't even notice it anymore. But it didn't have to be this way. The stock market wasn't inevitable. It was invented by humans in a specific time and place for specific reasons. And that means it can be changed, reinvented, reformed. Here's the question that keeps me up at night. Do we invent capitalism, or did it invent us? We think of the stock market as a tool, something we created to serve our needs. But is it possible the tool has changed us? Think about how we view the world now. Everything is a market. Everything can be bought and sold. Everything has a price. We talk about investing in relationships and personal branding and maximizing human capital. We've adopted market language and applied it to our lives. We measure success by wealth. We measure value by market cap. We measure happiness by consumption. These ideas weren't always dominant. In 1600, before the stock market, people cared about money, but their identities weren't as wrapped up in financial metrics. A merchant was also a father, a church member, a citizen. His worth wasn't solely determined by net worth. But after 1602, after the stock market became embedded in society, something shifted. Ownership became democratized, but so did the mindset of ownership. Everyone became an investor. Everyone started thinking like a capitalist. Maybe that's good. Maybe it empowered people, gave opportunities, lifted millions from poverty. Or maybe it changed us in ways we don't fully understand. Maybe it rewired how we think about value, risk, community, and success. The VOC is gone. It collapsed over 200 years ago, but its ghost is still with us. Every time a corporation wields too much power, we see the VOC. Every time a monopoly stifles competition, we see the VOC. Every time investors profit from harm done far away, harm they never see and never think about, we see the VOC. The VOC was both marvel and monster. It showed what humans can achieve when they cooperate and pool resources. But it also showed what happens when corporations get too much power, when profit becomes the only goal, when nobody is held accountable. We're still grappling with these questions. How much power should corporations have? How do we balance profit with responsibility? How do we hold companies accountable for harm they cause? These aren't new questions. They're 400 years old, and we still haven't figured out the answers. So what do we take away from this story? First, the stock market is not a natural force. It's a human invention, created by people in a specific place for specific reasons. Like any human invention, it can be changed, regulated, reformed, or even replaced if we decide it's not serving us well. Second, history repeats itself. The patterns of boom and bust, greed and fear, innovation and collapse. They've been happening since 1602 and will keep happening as long as humans are involved. Understanding this history helps us recognize when we're repeating old mistakes. Third, financial systems have consequences beyond money. The VOC didn't just make people rich. It shaped empires, oppressed millions, and changed history's course. When we participate in financial markets today, we're not just moving numbers around. We're influencing the world in ways we might not see or understand. Finally, we need to think critically about systems we inherit. Just because something has existed for 400 years doesn't mean it's good or right or inevitable. The stock market has brought enormous benefits, but also enormous harm. We have the power and responsibility to shape what it becomes next. It's 1602. A group of merchants in Amsterdam decide to try something new. They create a company that anyone can own a piece of. They allow those pieces to be traded. They create a market. It's a small moment, a local experiment, a clever solution to a practical problem, and it changes everything. 400 years later, we're still living in the world that moment created. The stock market touches every part of modern life. It funds the companies we work for. It powers the technologies we use. It shapes the economies we live in. But the stock market is not finished evolving. It's still changing, still growing, still causing problems and solving them. We're not passive observers of this system. We're participants. Every time we buy a stock, every time we save for retirement, every time we make a financial decision, we're shaping what the market becomes. The story of the stock market didn't end in 1602 or 1799 when the VOC collapsed, or in 1929 or 2008 or today. The story is still being written, and we're the ones writing it. 400 years ago, in a city of canals and shipyards, humans invented a system that would reshape the world. They did it to solve a problem. They did it to make money. They did it because they were clever and ambitious and maybe a little reckless. They had no idea what they were creating. They couldn't have imagined the New York Stock Exchange or algorithmic trading or global financial markets. They just wanted to fund some ships and share some risk. But their invention grew beyond anything they imagined. It became more powerful than any of them, bigger than their intentions, more consequential than their dreams. And now, centuries later, we're left with a question. What do we do with what they built? Do we accept it as inevitable? Do we reform it? Do we reimagine it entirely? That's up to us. Because just like the merchants in 1602, we have the power to invent, to create, to change the rules. The stock market was born in Amsterdam, but its future is being written right now by us. This is the story of how a piece of paper became worth more than gold. How an experiment in a small Dutch city became the foundation of global capitalism. How humans created a system that shaped empires, caused crashes, lifted billions out of poverty, and enriched a few beyond measure. It's a story about innovation and greed, cooperation and corruption, ambition and consequence. But most of all, it's a story about us, about human nature, about what happens when we try to organize risk, quantify value, and turn hope into something we can buy and sell. The stock market is 400 years old, and it's still teaching us who we are,